Man, the VIX has been all over the place this week. What's the message here with it now down 20% today, under 20?
Yeah, the VIX is during a mid-cycle rally like we've had since the beginning of October 2022, a very important signal about where you can step in and buy a dip. And we got a very key buy signal on Wednesday with the VIX closing at 27.6. That's just over one standard deviation. Only happened 2 times since October 22, right at the beginning of this rally, and then again in August 5, 6, and 7 of this year. And in both times, the S&P was up 4 to 5% in the month after the VIX hit those levels. So we've gotten that buy signal again, and we're very bullish here.
That's what I was just thinking, when you were talking about the VIX spike, I was thinking back to, I think it was August 5th. When we had all those concerns about Japan, and I think the VIX went to like 60 or whatever it was. And I mean, well, you're essentially telling me that whenever the VIX has a massive spike, that it's generally a buy.
It is. The only exception, and think back to 2022, we had several VIX spikes to 36, which is 2 standard deviations above the mean. Those weren't great buy signals because we were still in a bear market. The point is that when we're in a bull market, these VIX spikes are a real signal from the market saying fear is overblown and it's a good time to buy. And that's what we're seeing here.
Okay, so buy the dip. I mean, it's not like we don't have concerns to think about. Right? I mean, if the Fed's going to cut much less than we originally thought, and we're still not sure exactly how many times, just because they tell us, well, it's likely to be 2 next year, that doesn't really mean anything. That's our baseline to go off of. We have policy uncertainty and everything else. I mean, there are reasons to be a little cautious, no?
Oh, absolutely. Absolutely. And, look, Powell's press conference on Wednesday was kind of a disaster. We started with a comment that the rate cut on Wednesday was a close call, and we ended the press conference with his comments saying that he couldn't guarantee there were no rate hikes next year. And everything in the middle was just the same kind of mishmash of if this, then that. So there's a lot of rate uncertainty, you're right. But at the same time, we've got a good economy, a good labor market, and growing corporate earnings. And that's the recipe to keep this rally going, and that's why we're bullish.
Yeah. Where do you want to lean into then?
We really still like financials. They've had a great run this year, obviously, but they're still the second cheapest group in the S&P at 17 times forward earnings. You have tailwinds from lower than expected loan loss reserves because the economy will stay good, and the potential for deregulation. So the financials are still an area to definitely lean into. They've done the best this year, and they should have a strong 2025.
What about tech before I let you go?
Sure, tech is another area we still like. We do still like big tech as a group. We don't call out single names, but those 8 companies that dominate the top of the S&P should outperform next year as well. And that's another reason to be bullish. But it's not just tech, it's also financials. It's a much more broad-based rally than we had in 23.
Well, let me just ask you real quick then. I mean, maybe, are you saying you're not allowed to name single names, or because these things sort of stop trading like a monolith? Your answer sort of suggests that you think as a group, they're going to go up. Can you just clarify that so I understand where we're coming from?
Yes, you've got it exactly right. It's okay. if you want to play that space, then the Qs are a perfectly viable way to play. We think they outperform.
Okay, I got you. I just wanted to make sure we're on the level that you weren't talking about these all going up to the same degree. I'll talk to you soon, Nick. Thank you.
Thank you.
Nick Colas. Up next.